Hi, I'm Max Keiser, and this is the Keiser Report. The global insurrection against banker occupation is growing in velocity, amplitude, speed, and people. You know, in America, things are not so upheaval-like yet. Why? Because the price of gas hasn't hit that critical price level yet I've been talking about now for a couple of years. Once it gets to a certain critical price, all hell's gonna break loose in America! And then they'll join with the other countries in the global insurrection against bankster occupation. Let's talk with Stacy Herbert. Stacy?
Well, Max, at the beginning of the year, we did say one of the primary weapons the banksters use against us is inflation. And we do see that in our headlines today, Max. American anger at gas prices fueled by rising household energy costs. So Americans are now spending 12% of their disposable income on energy costs, up from 7.7% in 2002. A new study by Clearview Energy Partners says. Remember, 2002, of course, was before the invasion of Iraq, when we went in there to secure cheap oil reserves. Well, that didn't work out, did it?
That's right. Not only did they lie about blood for oil, but they screwed it up. They went in there for blood for oil, and then they screwed it up.
Well, exactly, because, and also the population of America who supported the invasion, of course, they screwed up by not looking at history. And one thing you find in history is that all wars cause inflation. So you might be able to secure the oil reserves, but the inflationary cost of military adventures is going to drive the price of that up anyway.
No, I remember now going back to the 2001, 2002 period. Remember there was this guy, Chalabi. He said his pitch to the Pentagon and to the American White House administration was that it'll cost $1 billion. It costs you $1 billion. You go in there, you take over Iraq, and then you pay for the whole debt in the first year with the oil revenues. I got a deal for you. Right now it's what, $3 trillion? And they don't even get the oil. So this guy Chalabi, he's right up there with some Charles Ponzi. You look up in the dictionary, Charles Ponzi, they should put a picture of Chalabi.
And also remember you interviewed Gregor McDonald, the energy analyst, recently. And one of the things you brought up is that the tipping point will come when a certain class of Americans start spending more and more, up to 30, 40, 50% of their income on energy costs. And we're starting to see that in the numbers. This study shows that in Mississippi, residents are paying up to 17% of their disposable household incomes for energy. So that includes household, heating costs and gasoline, but gasoline makes up the most percentage of it.
That's right. That's what makes the third world the third world. You put 50, 60, 70% of your income on buying, acquiring food, energy, cooking oil. And of course, the first world is the first world because those people don't have to spend more than 10 or 15% of their income on stuff to keep them alive. But now it's changing, and the people who are in the first world are really now in the second world. The first world is occupied by the Davos 5,000 crowd. They're the new first world, and that they never come down from their mountaintop retreats. Then the U.S. is now in the second world. And the third world, they're still in the third world.
So we're not just seeing the inflationary war against Americans, we're also seeing it in the primary area where we go to find those oil reserves. Mideast staggered by cost of wheat. So wheat prices jumped a week ago by 17%. Wet weather in the U.S. and dryness in Western Europe are driving the recent rise. Wheat futures jumped 7% on one day in last week, the biggest single day dollar gain in more than 7 months, and are now up for 91% in the year. So this is important because that region, which we now see the uprisings happening in, it was, many said, caused by inflation, and in particular in wheat prices. So Tunisians, for example, eat more wheat than anyone else on the planet. They eat on average 478 pounds per person a year, compared to Americans who eat 177 pounds.
That's like couscous. Love it down there, and I love it too. Good couscous, a nice poulet couscous. Can't beat it. But here's the thing about it. You see, these oil-rich nations around the world that got into bed with American central planners back in 1971 to create the petrodollar standard when the U.S. went off the gold standard to pay for the Vietnam War. Everything was rosy for a while. I mean, they had oppressive regimes and dictators, but, the price of gas and food was commensurate with their status as third world losers. But now, due to the ricochet effect of the monetization of everything that we used to be called debt, and now we've got a surfeit of cash creating huge inflation. Folks are getting screwed in the Middle East too. So it didn't work, did it? The whole experiment with the petrodollar. It was a big crashing failure. And now you're living with the people, of course, they are having the problem of the inflation. But for the rulers, you see, their problem is that the people are looking to change the rulers. They're looking for regime change. So the rulers thought they were so smart in getting in bed with American foreign policies and monetary policies. But now the rulers are being taken out one by one. They're being taken out in the Middle East, North Africa, Spain, Ireland, Greece. Regime change is the only answer because you're not going to teach these dogs a new trick. They're not going to suddenly become ethical. The regime leaders in these countries, they're all schnooks.
But if these prices are any indication, we could end up more like France and the Middle East. We could see reigns of terror because unable to grow enough wheat at home, countries like Egypt and Tunisia buy half or more of what they need from other countries and pass it along at deep discounts to their impoverished populations. As an economist at the World Bank said, this system is not very sustainable because at these prices, buying foreign wheat would consume about 6 to 7% of Egypt's revenues. And then the article in Wall Street Journal goes on to note, by comparison, the US spent a similar proportion of its revenues on the wars in Afghanistan and Iraq last year. So again, it goes back to this insanity of the guys who run all of the financial system, whether in Tunisia or America or Britain.
America can't afford the wheat in the donut anymore, and it's become the hole in the donut.
I'm not sure.
And Dominic Strauss-Kahn, don't let that donut near him because you know what he'll do to it. You keep your trousers on there, buddy.
I don't want to know what he does to the donut. But, okay, so these two stories then collide in my next headline, Max. Libya, Britain's £1 billion war. Libya conflict, lo and behold, could cost UK taxpayers £1 billion over 6 months as Gaddafi clings on and the cost of involvement soars.
This doesn't make any sense. How can Gaddafi cling on? Talk to the people about this. Talk to the people. It doesn't make any sense.
Well, as the article notes, demonstrations in support of Gaddafi are still common, and dissident groups are unwilling to engage his loyalist army. So it appears that unlike Tunisia and Egypt, where they were able to overthrow their decades-long dictators in those countries in a matter of weeks, it appears that there's a little bit more support for Gaddafi in Libya. But I want to note as well that this just seems like a pure racket because the UK is such a testing ground for the Chalabi method of selling the public on some private service, whether it's running the immigration and border checks or all these NHS fandangos that keep on happening, the boondoggles with computerized systems.
Fandango down at the Casbah.
These invasions throughout the Middle East are very much contractors, private contractors, these mercenary contractors, they make a lot of money on these and they sell these and they pitch these to the governments to get involved. It would only cost £100 million is what Britain thought it would cost. It's now up to $1 billion and who knows where it will finally end. But again, it's causing more inflation for the average peasant in America or Britain or Tunisia or Egypt.
Yeah, well, peace. There's no money in peace. There's no money in peace. You can't make money in a peace business. You can't make money peacefully overturning a regime. There's no money in that. I mean, the Catholic Church figured this out. That's why they don't follow Jesus. Jesus was about peace. They said, there's no money in peace. We're going to start the Crusades.
And get this, Max. The name of this this boondoggle that the private contractors have sold to British taxpayers, Operation Unified Protector.
I'm sorry, what was that?
Operation Unified protector.
It sounds like a brand of condom, doesn't it?
Well, that's what it sounds like. Yes, it does. But it's also...
You see, what the British people need is a prophylactic against excessive military spending. That's what the British people need. The American people need a prophylactic against excessive military spending. They need to take the entire Pentagon and slip it into a giant condom to prophylactically insulate the American people from being impregnated by this ridiculously overbloated military spending, which is causing inflation and causing the price of oil to go up, not down. You got it? The arrow's going up, not down. Do you understand that? The arrow's going up. You're paying more, not less. Are you freaking stupid?
Well, Max.
Yeah.
Speaking of prophylactics, China is now top gold bug. There is no better unified protector, of course, than gold. And China's investment demand for gold more than doubled in this first quarter of 2011 compared to 2010 to 90.9 metric tons. They now outpace India, which is historically the biggest investor in gold in the world.
New high in gold and euros. Making new highs in currencies all over the world, as we've been telling you. It's not just the Chinese and the Russians, it's the Westerners too, isn't it, Stacy?
Well, Max, global gold investment demand increased by 52% to 366.4 tons in the first quarter, helping offset a 56-ton outflow from exchange-traded funds, which are popular investment tools in the West. So we talk about this all the time. When you're protecting yourself from inflation and the insane bankers that run the entire world, every single nation on Earth and every single banking system on Earth, why go to a paper investment, which they also control? No, you cash in on your ETF and buy physical gold. Well, that's what it looks like is now happening. There was an outflow from the paper and an inflow into solid gold, real gold. And yet, despite this, the mainstream media, the BBC, the Telegraph, you've seen articles saying the gold bubble has popped because people like George Soros are selling their paper gold.
Well, the fiat money prophylactic has popped, causing all kinds of debt impregnation, while gold stands rock hard, baby. All right, Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
Don't go away, much more coming your way, so stay right there. Welcome back to the Keiser Report. Time now to go to London and speak with Ned Naylor-Leland of Cheviot Asset Management. Ned, old boy, welcome back to the Keiser Report.
Good afternoon, Max.
Let's talk about silver for a second here. You wrote a very interesting piece about silver price in its action in the 70s, where it made a 1,000% move, and why this is in fact indicative that we are nowhere near a bubble. Please talk about this.
Yeah, I just thought that it was something worthwhile to put out there for the nervous investor, which is that, you know, we really needed to clear the air, to wash and rinse, to move metal from weak to strong hands, in order to go significantly higher than we already were. I mean, there were lots of things that were going on in the background, and there's no question that the efforts that you've made have dragged all sorts of new people into the market as well. But I think what I was trying to express was that last time round this happened, the exact same thing happened. You had a late 20% move lower over a period of about 2 to 3 months, which is quite normal. Any kind of market that goes into a seriously parabolic spike will almost always have that moment where some of the weaker hands get shaken out, and that's actually all to the good.
Now let's talk about what your thoughts are on the Commodity Mercantile Exchange. They're raising margin requirements 4 times in a week on silver. Is it the normal operations to do so? Is it a sound policy, or is it nefarious? Is it an attack on silver? How do you weigh in on this?
It sounds like fingernails on the blackboard to me, Max, would be the way that I would describe it. You know, it's just desperation, really. I think it's just a sign of where we are in the grand scheme. It's easy for people like me. You know, I have been investing the whole way through the cycle, so these kinds of drops don't alarm me as much. But yeah, that kind of behavior, that kind of incredible hiking certainly would suggest that something is substantially amiss in the background.
All right, now Ned, I'm looking at all these protests around the world, in Madrid, in Italy, in Ireland, in Greece, all over Europe, all over the Mideast, all over North Africa. We're talking about now tens of millions of people, and it's growing quite precipitously. I would imagine this number will be in the hundreds of millions, not in the not too distant future. Based on your understanding of the size of the silver market, if in fact 100 million or 200 million or 300 million people who are dissatisfied with the banking occupation that's destroying their lives and creating hyperinflation, if each one of these folks bought an ounce of silver, what would that do? On the grassroots level, putting aside the hedge funds for a second, putting aside all of the financial engineering, putting aside all of the algorithmic trading and all the fancy high, top line garbage that's destroying the integrity of these markets. On the grassroots level, you get 100 million folks buying an ounce of silver or more. What happens to the price of silver?
I love this question, and I'm very pleased to be able to offer my view on it. I noticed it's now gone to 100 million, which is clearly, that is a big number. 100 million by an ounce each, and I think you could safely say there's going to be a very, very, very significant effect on it. I think actually the biggest effect of all, Max, is the one, just to be really tiresome and tie it back into what I was saying earlier, is I just think it's like a mushrooming movement whereby it's more the psychological effect on other people of you, but necessarily rather than the immediate price effect. Clearly, 100 million on one day taking an ounce each is going to have a substantial effect on the price. But I think it's more a psychological point than an immediate pricing one, because there is no doubt that there is still a lot more 1,000-ounce bar silver circulating in the world than there is coinage. So that you could make the argument that, well, there's an issue here with blanks, with making 1-ounce coins, and I think there's some truth in that, but it's massively netted off by this incredible growth at grassroots level and people who want in, and it's not just netted off; it's removed completely from the table as a problem. So I think 100 million people buy an ounce or 2 ounces or 10. Well, we would be in a whole different place very quickly.
I asked the same question of Eric Sprott on this show with the example of 1 million ounces, and his response was, "Well,
right.
I'm an institutional, primarily an institutional money manager, and we don't really think 1 million ounces. It wasn't going to register as a seismic event." Based on the numbers that he is used to. So I'm taking another bite at the apple here. What I'm trying to get from my experts like Eric Sprott or yourself, what is the sweet spot in this curve? 1 million, according to Eric Sprott, is not the number. 100 million, according to what I just heard you say, is yes, you'd have a very, very, very big event, in the market at some point. So at what, we know what the above ground supply of silver is. We know what the demand is. We know what the mining output is. We know what the trading volume is. We know all these things. So what is the sweet spot? What is the number that it would take to drive $1 up in the price of silver? Is it 1 million? Is it 2 million? Is it 2.5 million? That number can be extrapolated from the information that we have. What is that number?
I'm not sure it can be extrapolated from the data we have because there's too much data we don't have, Max. So I'm not sure I agree with that, actually. But what I would say is I actually think maybe that's the point, is these 1,000-ounce bars, actually. I think perhaps, although, yes, without question, the core and most important point is people at the grassroots level taking smaller denomination coins out of circulation. I think actually the shorts are somewhat relying on this inventory of 1,000-ounce bars in the warehouses. And I don't just mean COMEX, by the way. I mean, in metals warehouses. I think if hedge funds and investors realize the difference more clearly between physical and paper silver, they'd be much more willing to pay the insurance and storage charges for 1,000-ounce bars. And I think if a load of those got locked away, I don't want to stick a number on it, but I think that would have a very, very quick effect on the market. It would cause all sorts of interesting things to happen. Like, for instance, the bullion dealers start getting charged a whole load more for storing silver, for moving silver, because there'd be much more activity in the warehouse.
Talking about the 1,000-ounce bars and the warehouse, we know that the COMEX warehouse stocks of 1,000-ounce bars is plummeting.
Yeah.
Now, what are the numbers you're seeing there, and how much of a problem is that? At what point does COMEX announced that due to the drop in inventory, they're going to have to make some other provisions.
Well, it looks like they were very close. I mean, that to me is what it looked like, Max. I mean, that's looked like where we got to. So, you know, the COMEX is a very small part of the overall gold and silver market. It takes an inordinate amount of interest because of the visibility of it. Perversely, it's actually the visibility of COMEX which allows us to grab onto it as being, you know, incredibly important. But I think it's just as important, you know, your private bullion storage businesses like Viamat in Switzerland. You know, this is where high net worths, hedge funds, etc. That's where they store metal, and I actually think that is probably the really key point. But yeah, reference COMEX. There's no question it's getting tighter and tighter, and more and more people are watching what's going on there. But with the benefit of the bat phone through to the CME. It may not be about to happen, you know, in the next month. Okay,
so just to give you the numbers here, according to Zero Hedge, COMEX is now down to 32 million ounces, down from 87 million in 2009. So there's a large drawdown. But I want to just wrap it up here and focus in a little bit on this, where you're talking about the 1,000-ounce bar market. And it sounds to me as though you're describing really two markets, the 1,000-ounce bar industrial, the institutional market, versus the 1-ounce retail coin market, let's call it. And that, according to you, these are on two parallel lines that don't necessarily intersect. But it seems that at some point, if enough of the 1-ounce, half-ounce, 10th-ounce silver bullion coins are taken off the market, and we already have bottlenecks and shortages in coin dealers around the world, at some point, again, this grassroots effort has got to bleed over into this institutional 1,000-ounce market, because unlike paper money, there's a limited supply of silver, and we know that it's an extraordinarily limited supply of silver. I mean, we're talking about 1 billion ounces available. Half of that's tied up in ETFs. Now, some have said, well, if the price goes high enough, you'll see silverware flying out of the kitchen cupboard, and that's going to bring in another huge, a supply will be materializing, as we saw in the 70s and the early 1980s as well. But even taking into consideration that number, you're talking about a total market that's certainly at less than 100 billion in total. And that includes every silver button that's been attached to every sequin of every gown, of every Bob Mackie gown ever paraded at Radio City Music Hall. It's still quite a bit less in size than the $700 trillion derivatives market, which is unwinding at this moment, and people involved in that market are looking for sound money. So even given...
Absolutely. They're looking for...
Go ahead.
I think that just again to sort of tie in that with the 1,000-ounce bar point, just thinking about this quickly, rather than ordering metal from, I'm not going to mention the name of a mining company because I shouldn't do that, but from one of mining companies that you can order silver through, that's future production. I'm not sure actually, but now I think about it, whether it wouldn't make quite a significant difference if one wanted to do some kind of minting program to mint a certain number of coins, if one was in the market to do that removing 1,000-ounce bars from the warehouse, which could be done, I mean, it would require a little bit of work in the background, but I don't think there's any reason why that couldn't be possible. That, in a way, would kill two birds with one stone, because you're putting more metal out there in 1-ounce form, and you're also removing the big bars from the warehouse. So maybe there's something that can be done there.
Okay, Ned, this is what I like about Ned. You got the out-of-the-box thinking. Now, run it by me again, because I want the listeners and the viewers to understand what you're saying here. Run that by us again.
Well, you said that and I like what you're saying, is there's the two parallel lines here between the market, and closing them is an issue. But maybe that's the point. Is maybe we need to try and make them converge by supporting these private minting initiatives, the likes of which you've been involved with, and actually, rather than securing the raw silver from a mine, making sure that the only time one mints coins is by taking delivery of the 1,000-ounce bars from the warehouse, which will put pressure on them while also getting metal into people's hands. I think that could That could serve quite an interesting purpose. I think we need to have a look into that in the next few weeks, actually, Max. It's got to be something that's worth investigating.
All right, I think that's very interesting. And up until now, no one's really made that connection. So Ned, once again, proven why everybody in London is talking about Ned Naylor Leland and the fact that he is a stark raving genius over there at Cheviot Asset Management. And they're also talking about some of the ties that you wear, because they like the fact that even though underneath that button-down shirt is a stark raving genius, you still managed to wear the conservative ties.
I'm not going to say anything, Max. I thank you for the compliment anyway.
All right, well, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Ned Naylor Leland of Cheviot Asset Management. And if you want to send me an email, please do so at Keiser Report at rttv.ru. Until next time, this is Max Keiser saying bye, y'all.